Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden secrets within corporate filings, and in this report, we've got a real puzzle to piece together. It looks like Renewables Incorporated is playing a bit of a financial shell game with their preferred stock and some clever accounting maneuvers. Stick around as we break down their latest 10Q filing before we dive into the labyrinthine world of corporate finance. If you appreciate getting straight insights from these big corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we chat about these filings and more. Alright, let us start by looking at the big picture, the balance sheet from the 30th of September 2025 compared to the 31st of December 2024. The company's total assets took a bit of a dip, going from $344.9 million to $304.8 million. That is a drop of about 12%. Now, what caused this? A big chunk of it is a decrease in accounts receivable by about $19 million, and also a significant drop in restricted cash from $17.1 million down to just $2.4 million. This could mean they are collecting more money faster, or simply that less cash is being held aside for specific purposes. Let us look at the numbers for accounts receivable. As of the 30th of September 2025, the company had $45.5 million in accounts receivable, a decrease from $65.4 million at the end of 2024. This is a positive sign. It means they are collecting payments from their customers more efficiently. Another interesting item is the fair value of derivative assets. These are essentially contracts to manage risks associated with fluctuating energy prices. For the 30th of September 2025, they had $579,000 in derivative assets, a big drop from $8.7 million at the end of 2024. This suggests they have reduced their exposure to potential price swings or have entered into different types of contracts. On the liability side total, liabilities also decreased from $180.8 million to $161.1 million, which is a good thing, showing they are reducing their obligations. Now let us talk about their series of preferred stock. This is classified between liabilities and equity because it has certain features that are not fully controlled by the company. The number of outstanding shares has decreased from over 3.3 million to about 2.8 million. That is a reduction of nearly 500,000 shares. This happened because the company repurchased some of this preferred stock. The total value of this preferred stock also went down significantly from $83.2 million to $70.5 million. This buyback strategy can be good for common stockholders as it reduces the amount of preferred stock that accrues dividends. Let us move to the income statement. For the 3 months ending the 30th of September 2025, net income attributable to Renewables stockholders was $757,000. This is a big drop compared to $2.1 million in the same period last year. The 9-month period also shows a decrease from $18.3 million to $12.3 million. Essentially, they are making less profit. And when we look at net income attributable to Class A common stockholders, specifically here is where it gets interesting. For the 3 months ending the 30th of September 2025, they reported a net loss of $1.5 million, a much bigger loss than the $569,000 last year. For the 9-month period, they went from a profit of $10.2 million to a loss of $5.3 million. This is a dramatic swing and definitely something we need to watch. The weighted average shares of Class A common stock outstanding have increased though from 3.3 million to 3.7 million, which means each share represents a smaller piece of the company's profits when they do exist. Now let us check the cash flows. For the 9 months ending the 30th of September 2025, the company generated $46.3 million from operations. This is slightly less than the $48.4 million generated in the same period last year. This operational cash flow is critical for the company's ability to function and pay its bills. While it is down slightly, it is still a healthy amount. In investing activities, they spent $16.4 million this year compared to just $2.9 million last year. This big increase is mainly due to spending more on acquiring customers and customer books. This sounds like they are actively trying to grow their customer base, which can be good for future revenues, but obviously costs money now. Financing activities show a much larger outflow this year. They used $44.1 million compared to $21 million last year. This is largely driven by buybacks of their series, a preferred stock, and increased distributions to non-controlling interest holders and controlling interest holders. Specifically, the buyback of series of preferred stock alone was $12.8 million. Back to the balance sheet, if we look at their derivative liabilities, they have moved from an asset position of $9.1 million at the end of 2024 to a liability position of $1.7 million as of the 30th of September 2025. This change suggests that the positions they have taken to hedge against commodity price fluctuations have become less favorable. in value. Looking at the segment reporting, the retail electricity segment shows a gross margin of $21 million for the 3 months ending the 30th of September 2025, which is down from $24.6 million in the same period last year. This is primarily due to a lower unit margin per megawatt hour, which dropped from $43.65 to $36.91. That is a significant decrease in profitability per unit of electricity sold. On the natural gas side, things look better. The retail gross margin increased from $5.5 million to $6.8 million. However, the margin per millimeter BTU decreased from $4.16 to $3.24. This increase in overall margin comes from selling significantly more natural gas volumes, an increase of over 783,000 MMBTU. This volume growth more than offset the lower per unit margin. For the 9 months ended the 30th of September 2025, total revenues increased by about 14% to $335.6 million. This growth is primarily driven by selling more gas and electricity volumes because they have a larger customer book thanks to those acquisitions we mentioned earlier. However, they also saw lower natural gas rates and other revenue compared to the previous year. And importantly, their retail cost of revenues jumped by a massive 32% to $237.9 million. This increase is heavily influenced by changes in the value of their derivative portfolio, which is a complex way of saying their hedging strategies cost them more. It also reflects those higher gas volumes and rising natural gas costs. General and administrative expenses have decreased by about 15% for both the 3 and 9 month periods. This is good news, and they attribute it to lower bad debt and legal expenses. Less spending on these areas is always a positive sign. However, depreciation and amortization expense has more than doubled, going from $2.5 million to $5.6 million for the 3 month period, and from $6.8 million to $15.9 million for the 9 month period. This hike is mainly because of higher amortization costs related to those customer relationships and other intangible assets they are acquiring. Customer acquisition costs have also gone up, particularly in the 3 month period, a 62% increase. This shows they are spending more to bring in new customers. There are some significant legal and regulatory matters to note. In Illinois, Spark Energy received a demand letter from the Attorney General alleging non-compliance with marketing and sales practices. They are in mediation talks, and the Attorney General has filed a lawsuit. This is an ongoing situation with substantial uncertainties. Also in Maine, their subsidiary Electricity Maine LLC was investigated for compliance with commission rules. They reached a settlement that involved customer refunds and a fine for the company. There is also a class action lawsuit concerning the merger. A purported stockholder is alleging that the directors and controlling stockholder breached their fiduciary duties. This action is still pending, and the defendants have filed a motion to dismiss. Now for my take on Via Renewables. On the positive side, they are actively acquiring customers, which shows ambition and a strategy for growth. Their operational cash flow remains solid, and they are managing their general and administrative expenses well. However, there are some significant warning signs. The net income attributable to common stockholders has swung from profitability to losses, and the cost of revenue is rising much faster than revenue itself. This points to a potential squeeze on margins and profitability. The increase in depreciation and amortization due to acquired intangibles and the higher spending on customer acquisition also indicate a strategy that is front-loaded with costs. The complexities around their series are preferred stock and significant share buybacks, while potentially good for common equity holders, also highlight a need for careful financial management and a focus on core profitability. The legal and regulatory issues in Illinois and the ongoing merger lawsuit add a layer of uncertainty. In conclusion, Via Renewables is in a period of aggressive growth and acquisition, but this is coming at a cost. Investors should closely monitor their ability to convert these customer gains into sustainable profitability and manage their rising costs and legal exposures. Alright, that is our breakdown of Via Renewables Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.